Hey people, thanks for stopping by at Building Wealth with Rajeev. If you guys are still wondering how some successful investors are coping with the downturn, this chat is just right for you. I talked with Joe slash Stock Novice again. Stock Novice and me talked in December 2021 when his portfolio was up by more than 500% from 2019 to 2021. You can find the last interview in description below. Now, in this interview, we talk about how's he managing through the downturn. His portfolio is still up by more than 200%, by the way. What has changed for him? Will he do things differently? What are his learnings? Hope you like listening to a successful investor. Please follow my channel for such meaningful discussions in future. All right, Joe, you there?
Yes, sir. Thank you, and appreciate the repeat invitation.
No, I appreciate you coming because you know, I think I've been following your newsletters and been a big admirer of how you look at the companies and we've come a long way from December to what now in August, about 7 8 months. How do you feel about this? What's going through your
Uh,
head?
well, it's interesting because I remember when we talked in December, as we mentioned, at that time we were in about probably an 8-week drawdown. Most people, at least that were in growth stocks or high growth stocks, kind of early November, they had hit their high. So, we talked toward the end of December, so it was about a 6 or 8 week run where it was a fairly sharp pullback. And here we are now. It's 6 or 8 months later, and that we wish we would probably had our the
Yeah.
same the level of portfolio value that we did in December. So it's been a tough year, and it's been a tough year for really in any asset class. There's really been nowhere to hide. You know, growth stocks, value stocks, all the indices of crypto. There were at one point even bonds because of inflation, the return on bonds. I saw something at there was one point where bonds were further down in their drawdown than the Nasdaq was, which if stocks are bad, is particularly tech stocks, bonds are supposed to be the saving grace, and that hasn't even worked out well in 2022. So it's been a historically bad year, for everyone. And I know had gone through 2000 and gone through 2008, but I know for a lot of investors, this is the first one of these that they've gone through. And when you read articles about, the worst 6 month start ever at the end of June, and then there was one point, I believe it might have been in early July, where it was like this was the worst start since 1932. Well, if this is the worst start since 1932, that pretty much means that there's no one really alive that was investing, in 1932. Even buff guys as old as Buffett and Munger, who are nonagenarians that we admire very well. This is one of the worst markets if not the worst market they've ever had to navigate as well. So clearly, a lot of lessons for a lot of people. I think it's made a lot of people look at what their investing style is, and really has tested a lot of people's, I think, risk tolerance, and also really made them look at their process to make sure that they're doing the right things for the nest egg or the retirement accounts that they do have, no matter what asset class, really, whether it be stocks, bonds, crypto, real estate, whatever it is. Everybody's had a chance to take a hard look at what they're doing and make sure it's the right thing for them.
And what I think that's a great point to make. So you've seen two drops, big drops, 2000 and 2008, right?
Right.
And I think they were different in different sense. I mean, 2000 started with dot com, 2008 banking kind of meltdown. Now 2021, 22, nothing. Oh, okay, let me put it. What did you learn, Joe? You're a seasoned investor, so like Charlie Munger says, always inward. So let me start from
Right.
now. You look at the
Uh,
situation now and think backwards.
I do. Yeah,
What would you do differently?
there's a I don't know that there's no so much differently, as much as I think one thing that I will look to do going forward, which might be a change for me. I think there's a couple things. One of them is how I view cash. I had always been fully invested. It was always something that I wanted to make sure that I had everything in the market, because I knew you couldn't really time it. But I do think as you move along in your career and as the amount of your portfolio gets bigger, you probably shift a little bit between capital growth and capital preservation. So I know that
Hmm.
that's something that I've been thinking about a little bit, but ultimately, whether there were different reasons for 2000 or 2008 or now 2022, um, the one lesson that I think I've really learned, one, you can't time things. You can't time the market. So a lot of the things that I've seen about, I would have done this or I should have seen that. It's all hindsight. We don't really know. We don't know whether the market's going to go up or down tomorrow. So to say that we could have foreseen something doesn't really. I don't think that's really true. You can think in terms of risk management, growth versus preservation, those types of things. But in general, I don't think there's any real strategy. Oh, I should have seen this. I don't think that exists. And I think people that try to do that are fooling themselves. The one thing I will say, in all three of those cases, it really has reinforced. It really is about finding the best companies, and the more that I do this, and the longer that I do this, that lesson actually just keeps getting reaffirmed. The best companies are going to go down along with the others, but they will be the first ones to rebound. And you really separate, the wheat from the chaff as far as the quality of the companies. And I'm still sticking to the same process. The quality companies are the ones that do seem to be rebounding the most and rebounding the fastest. And I think those are the ones that are going to come through stronger on the other side. And if you own companies that can't withstand a down economic cycle, it's probably not a good company to begin with, because in the history of companies, the ones that have come out on top and been market dominant leaders for a long time, they have things that give them an advantage in both good and bad economies. And I think that's even in the software space and some of the things that I'm in right now, I think we're finding that some of the quality companies are going to come through this and they're going to be just fine.
So, okay, let me two things I have here now. Strong companies, yeah. There is a
Mhm.
definition of strong companies. There was a definition in 2021 December when we talked.
Right.
Is that definition got sharpened further?
I think the definition is generally the same. I view companies in there's really three main areas. That the first one is kind of the top line, what you might see with growth or gross margins, those types of things. They usually give us some sort of execution metrics. It could be customer count, it could be subscriber count, it could be in software, it could be the number of modules that are being used for with a percentage of customers, or the net retention rate. For something like Peloton, it could have been the number of digital subscribers that they had. They tend to give us execution metrics. And then the bottom part of it is always cash flows and profits. So I tend to look at it that way. There's kind of the top line numbers, there's the underlying execution metrics that the company usually asks us to track. And then there's how the cash flows and margins are coming, profit margins. And what I've found over time, and I think this is true for the majority of successful companies in almost all industries, they're invariably going to start small and grow fast. And then as they mature, the law of large numbers is going to make that growth slow down. But as the growth slows down, you should start to see the cash flows and profit margins start to pick up. So then you get companies like Apple or Microsoft or an oil company where they're churning out cash flows left and right. As their growth is slowing, you see cash flows go up. Sometimes if they're super mature, they turn into dividend companies. But you always think of it like tipping the scales. As the growth goes down, you want to see the underlying executional metrics still make sense, and then you want to see that the cash flows and profits go up. And I think good companies always tend to follow that trend. They get a lot of leeway early on with cash flow. Young companies get a lot of leeway early on with things like cash flows and profits, as long as they're maintaining growth. But I think what you're seeing now, particularly in a kind of a skittish market, the companies that people are paying a lot more attention to cash flows and profits, because as a downturn in the economy is going to slow growth kind of across the board, you want to make sure that you have a company that has a strong enough balance sheet and the wherewithal to be able to ride out the storm, I guess, for lack of a better way to put it, so that they can come through the other side. So I think that's always the balance between companies, and obviously I tend to try and find companies that are earlier in the growth stage and earlier on their S curves. But even the companies that I own, like a Datadog or a CrowdStrike or a Zscaler, they are companies that have made that transition where even in this tougher time, they are still turning out cash flows and non-GAAP profit margins that allow them to self-fund themselves and self-sustain themselves, to be able to hopefully ride this out and come through the other side in a stronger competitive position.
Yeah. So look, so let me just ask this question. Um, so what's different for you now? Is that like in terms of you talked about some cash, right? Those cash
Right.
positions and all that. Is that the difference? Like you kind of respect for cash?
It
I was
has been.
yeah,
Yeah, it
yeah,
has been. It's something I've done differently in 2022. And in all honesty, and I know you talked with Investing Bear on here. It's
yeah,
something I picked up from him. I know him well, and we talk quite a bit. And I admire the fact that he's done that. I think one of the lessons that I've learned, again, as my portfolio has gotten bigger and over time, I don't have to have all of it in the market all at one time. And what I've realized is that I've really challenged myself. I do feel like I have very high standards for what companies clear the bar to get into my portfolio. And I wrote last year about having kind of conviction tiers as I think about my companies, and those conviction tiers tend to match up to allocations. And I think what has happened is I just have to be honest with myself that where a lot of these companies are right now, and with some of the struggles that they might have or headwinds that they're facing that weren't there before, those conviction levels are naturally going to slide down. And what I don't want to do is I don't want to let my allocation level get too large for my conviction level. So I've been asking myself, do I want to own this company? Yes or no? And if I do, then I put it in my portfolio. Then how much of it am I comfortable owning? And I will push to that maximum amount. It could be 6%, 8%, 10%. But once I get to that kind of maximum, I'm not going any higher. And if I don't have any more companies to own, or I have everything up to my conviction level, I've just left the rest in cash until I either find another company I like, or someone, tells me that they deserve some more. So, for instance, I was carrying about, I'd say probably like 20% cash or 22% cash, which is high for me. And then, Datadog reported. I liked Datadog's report, but it's clear that they have some usage-based headwinds that are going to hit them for probably the second half of the year. So I had bought Datadog a lot over the years. It had grown into my biggest holding. It was about 24%. And I had trimmed it about 4 or 5 months in a row to keep it under 25. And on this last report, when it said, hey, our usage is down a little bit, and we're gonna kind of tighten up, be very conservative in our guides. Well, I don't want to own 25% anymore. So I cut it down to about 16. Well, now, that bumps up my cash, and now I'm sitting at like 26 or 27% cash. And then Cloudflare in turn has a report, and I really liked Cloudflare's report. And I bumped that about 1% or 2 to get it up to about 10%. So now, I've cut the cash from 28 to 26, but I only want 10% Cloudflare, and I'm comfortable with about 16% Datadog. And if I have extra cash left over, I'm okay keeping that in cash. Because I think one of the mistakes that I made earlier this year, was I let Bill.com and Monday.com get a little bigger maybe than my allocation conviction should have, because I was trying to make sure that I stayed fully invested and I didn't want to add any more companies. And that ended up costing me money. And I don't mind, stocks go up or down. So I don't mind, if I quote unquote lose money because a stock underperforms from a business standpoint, and I had it the right allocation. And sometimes it just works out that way. But I look at that, having too much of an allocation where your allocation is higher than your conviction level. I think that's an unforced error that I don't want to make. And it's one that I got burned on a couple of times this year. And it's one that I'm pretty sure I will not make again going forward, because I'm a lot more content to just sit on the cash right now. That is a change for me, but that's specific to my situation more so than anything. If I was, 25 years old and working and putting in every 2 weeks, I probably would make sure I got every dollar I could in there, because I know I have time and compounding on my side. The longer you go, a little less I have as far as time and compounding coming back in my favor. So I'm just trying to be more open-minded about how I approach my portfolio.
I think that is very insightful, Joe, because my also one of the learning has been the age. I think you know Warren Buffett's guru, what's his name, the Graham, right? I read his book, and he talked about the age factor in his book a long time ago. That when you're 40, when you're 50, when you're 60, you kind of ratios change, and I kind of snubbed it off. I was little beast. I mean, nobody in front of them, but and that came back to me now that the age matters, and you kind of rejuggle your portfolio. Capital preservation has come top of my head as well. So I kind of
Right. Right. And I think there's always a split between growth and preservation. I know a lot of
mm,
people do, they'll do the 70-30 or the 60-40 portfolio where
mm,
it'll be, 70% stocks, 30%
mm,
bonds, get older, 60% stocks and 40%
mm,
bonds. I think there's different ways to handle that. I know some people that do it where it's like, okay, they stay in growth, but they'll carry, 3 years of cash or 5 years of cash worth of living expenses. And if they have a really good year, they'll top up the cash but they know they have cash there that'll sit there to let them get through a cycle. So there's plenty of ways to do it. And it's always about finding what works for you. For the longest time, cash as an allocation made my skin crawl, to be honest with you. I was
mm.
more uncomfortable holding cash than I was being fully invested and watching the rug get pulled out. But I do think with this particular in looking at it, just trying to hold myself accountable to companies I want to own and making sure I don't get past my allocation. If there's money left over, there's money left over, and if it's enough to get it all in there, that's okay too. And that's an adjustment I've made this year, and I'm sure I'll make more as I go.
Yeah. Now, so last time when we chatted, one of the things which got me is that expectations from the companies.
Hmm.
You tend to have high expectations from your companies, and expectation is a numerical word, as well as there is a subjectivity involved in it. Now, did your companies live up to your expectations? I mean, would you buy again? I mean, would you, if the time wheel goes back, would you still buy them, all of them?
Yes. Yes, yeah, I would, and I think where you also have to play the hand that you're dealt, and there's probably a lot of people that might play cards, and you're going to play pocket nines different than you're going to play pocket aces,
Yeah.
and when you had a company like a Datadog or Cloudflare or Zoom, when you had Zoom at the beginning of the pandemic, I mean you were playing pocket aces, you just were. And the stock went up accordingly, and now that now it's a little bit tighter economy, and people are paying more attention to what they're spending, and corporate companies are being a little tighter with their spend, making sure that they're getting a good ROI. And what I've found with the companies that I've tried to get to is I want companies that are mission critical. They're very, very important. Their products are very important to their customers, but I also want companies um, that are enterprise companies that are selling to businesses. They're business to business customer or companies, and not business to consumer companies. And when I think of a company like Datadog, Datadog sells to companies. And yes, those companies a lot of their customers may in fact interact or face consumers, but the things that Datadog is selling, or CrowdStrike is selling, or Zscaler is selling, those things are super important to those companies keeping their doors open from a functioning standpoint, from an operational standpoint. So that's a little different than say Roku, where am I going to buy that TV or am I going to pay for that subscription? Like, that's different. And the consumer is just a lot more the consumer's a lot more fickle and a lot more sentiment driven and a lot more volatile in their ability to change their discretionary spend. I'm looking for companies that aren't as affected by the discretionary spend of their customers. And there's always going to be tightening in economic downturns, so you do adjust accordingly. It's not 2020 anymore, or it's not 2021 anymore, and you have to be realistic. But these are still some of the best companies around. And when I think about how the market has reacted this year, I've seen, Disney was back at one point to where it was in like 2015, and Facebook was where it was back in 2017. And I saw Netflix was back to where it was in 2016 or 17. Well, you know what? CrowdStrike's never gotten back to where it was when it was $60 on its IPO day. And Datadog's never gotten back to the $40 that I bought it at one point. So those companies, relatively speaking, are holding up well. And they're still some of the better companies around. And yes, they may have a more difficult playing field in front of them, but they're still some of the best players on the field. And I want to try and, again, always hold myself accountable to making sure I'm in what I think are the best companies. So I try to keep those standards as
Awesome.
best I can, but I try and adjust them to what the playing field's telling me as well.
Okay. Now, the question which I'm asking is that you talked about, the heavy cash in your portfolio, right?
Mhm.
What are the gems you're discovering? Are you kind of there a list of companies you're looking at which look good to you?
Yes, and like Monday.com reported today, and they were one that I owned, and they went back on my watch list. I thought they had an okay quarter. I'm going to keep them on my watch list. I did not get back in, but I was taking a look at Zoom Info, and I've really tried to take a look maybe at some companies outside of the software space. I don't want to be pig-headed, and if I have the best software companies, I am very familiar in that space. If I don't have any other companies that I want to own, there are plenty of other businesses in the world. And I've looked recently at a company called Enphase, and Enphase sells solar inverters for solar panels. And now that's a company that sells widgets. So now that's lower gross margins, and there's supply chain complications and manufacturing complications that software companies don't have. So it's not as clean and frictionless of a business model. But living here in the U.S., there was just a big spending bill that was passed. It's going to be the largest ever contribution to clean energy, and we know that there's some inevitability to solar becoming a bigger part of what we do to power the world. And that's a secular tailwind, just like the digital transformation is a secular tailwind. And if so I'm taking a look at Enphase a little bit.
What's
I've
the
taken
ticker symbol?
N as in Nancy, P as in Paul, H.
Okay.
ENPH. And I believe they just hit a new all-time high the other day. And there's not many companies in the market that are hitting all-time highs these days. And they're one of them. Another company that I'm looking at, which is much, much smaller. It's one I've looked at in the past, called Transmedics, I believe. It's TM as in Mary, D as in dog, X.
Mm,
And what they do is they have a technology that they are trying to disrupt the organ transplant space. Usually, with organs, it's just on ice. You keep them on ice and get them to the next person as fast as you can. And they have a proprietary system that actually is able to use blood, oxygenated blood, to keep organs fresh longer, and allow a little better matches, more time to get the right donor match, and allow surgery teams to set up. So seems like it's a win-win for the patient, for the doctor, for the hospital. They're a very small company that has had some success and is just had some FDA approvals. And that's one that I'm looking at. I've dabbled in the med space before. That's always a little bit tough in the medical space, because there's so much inertia and so much red
mm.
tape you have to jump through. But that's a company I'm looking at. And I don't know exactly what I'm going to do. I mean, obviously I write my things up at the end of the month. I don't own any of those companies yet, or either of those companies yet, but I do want to have some alternatives, because at some point, rising tide lifts all boats. I am going to want alternatives that are better than cash. And if there's not something in the software space that really appeals to me, I want to try and make sure that I give myself some other options. So I think I don't know if this is, I do think the sign of a good investor is being nimble and being open-minded and being able to pivot. I don't want to call myself a good investor, because I could pivot right into losing more money. So my pivot might not be a good one, but I do want to try and be open-minded to making sure that I'm in the best companies and at the best time. And I don't want to fool myself that there's only, one way to skin the apple.
So there's a couple of more questions before we end. So why aren't you buying these companies? Stock movies. What are you waiting for?
Still, really just because I'm still in the due diligence stage
Okay.
with both of them. I like what I've read so far. There's a part of me that's like, I could, again, you're always fighting psychology a little bit too, just being
Mm.
honest about it. In the Transmedic case, the TMDX, I'm still doing my due diligence and still reading some things. On the Enphase one, I feel like I'm in a pretty comfortable spot with the company. They're doing business in Europe. And with the gas situation, gas and electric situation in Europe, it sounds like they could get some tailwinds there as well. And I think that one is just, it's at all-time highs. Do I want to jump in right now? How much do I want to do? So, plus the fact that I'm juggling some earnings reports right now. I mean, Datadog just reported, Cloudflare just reported, Monday just reported. I have Bill.com coming up. I have Snowflake coming up on the 24th. I have CrowdStrike coming up on the 30th. So, and just trying to make sure that I guess kind of manage the workflow between the due diligence of the companies I'm looking at and the companies that I already own. Because these companies are from a different space, I'm not as familiar. The due diligence isn't quite as quick as if I'm running another software company through my checklist. That goes a little faster than when I'm trying to run a company that makes solar inverters, because I'm not quite as in tune with exactly how that industry works as I am with some others.
All right, nice. Now, my thing again, which puzzles me, and did you have a rethink on valuations? Last time we talked about it, and you were pretty neutral to valuations. I mean, is that
Yeah.
is that bear market? You know, did
Uh,
did challenge that
yeah,
belief?
it has a little bit. And this is one, I mean, you can go round and round on valuations are beat down for everything.
Mm.
And people that, like those software companies, they were so expensive in November. Yeah, so was everything else. Well, look at where Nvidia was in November. Look at where Netflix
Yeah,
was.
yeah,
Look
yeah.
at where Berkshire Hathaway was in November. So again, it's all relative. I do think one thing that I am noticing is I do think multiples that get disconnected a little bit, I will be paying attention to. So, the two ones that stand out for me, and I guess I played both of them somewhat correctly. I always thought when Snowflake first came out, it was so expensive and the valuation was so high right out of the IPO. It
Mm.
was like twice as much as everyone else. And I stayed out of Snowflake for a long, long time and didn't get into it until a much more acceptable price, and one that worked out much better worked much better for me. And I think the other one was Cloudflare. There was a time where Cloudflare ran up, and Cloudflare, in the fall was probably $200 a share, maybe 220 it had gotten up to. And its valuation was so disconnected from its peers. So you had Datadog growing at 80%, you had CrowdStrike growing at 65%, and you had Snowflake at the time growing at 120%. And Cloudflare is just chugging along at 50%, and Cloudflare is more expensive than everything but Snowflake. So I do, and I actually at the time had owned about 14% Cloudflare, and I cut it down to 11, and then I cut it all the way down to like 4% because at some point the price just didn't make sense. So I feel like multiples and valuations tend to be relative. They're either high or they're low. Like even now, I can see things and people are like, oh, the S&P 500, there's still room to fall because when it reverts back to a price to earnings of 14 and it's only 16. And I'm like, yeah, that's okay. But how many years have you been waiting for it to revert to 14? How much money have you left on the table during that time? So for me, it's more about yes, sometimes we're going to be in a high multiple environment, and sometimes we're going to be in a lower or compressed multiple environment. I think the one thing I might try and think a little more differently about going forward on valuations are companies that look disconnected to the high or the low in reference to their peers. At least in the software space, I know these companies have high multiples because most of them have growth and gross margin and profit margin combinations that no other companies in the market have. So they should be more expensive. How more expensive should they be relative? I don't know, but I know that I'm walking that fine line, which is why I try and hold them to high standards anyway. But I do believe I'm always going to end up gravitating toward higher valuation companies because I'm always going to gravitate to those that have the best business performance. I do think I will pay a little more attention or try and pay a little more attention to individual companies that look disconnected from their peers. Does that answer your question?
No, it does, and as you said that it's there's no right or wrong here. I mean,
Right, exactly. It's
yeah,
all about your individual
there's
style.
no
Yeah,
formula, and I mean we
right,
have these DCFs and all that, but these
right,
companies which you are investing in, I don't know whether DCF makes any, DCF can be able to predict something or not. I mean these are
right.
slightly, it's a complex game.
But I've
Now,
one thing I think it's important, and I don't mean to interrupt, but I do think this is real. I actually had a long talk with someone who's a value investor that I admire, and
who was that?
she it's a female, someone that I know. Her name's Kate, and she pays a lot more attention to valuation than I do, and
Okay.
she respects my process a lot. And to be honest, I respect her process a lot as well. And one of the things that we talked about at one point is that when you do what I do, or the style that I do, you gravitate toward the business and you hold it to these standards. You know it's going to be a high valuation, and the second the company tells me that doesn't deserve that high value, I'm out. I can discard it. When you pay attention to valuation, you see a good entry point, like, wow, this is growth at a reasonable price, or it's a value stock. I really like where the price is at right now. Well, that's no different when you get it at a good multiple. Well, you have to have an exit strategy in mind too. So if I buy Berkshire Hathaway because I really like where the multiple's at, if it's at a multiple, and I don't even know, like, I'm just going to make it up here. Let's say it's at 6. Do I sell it when it gets to 8, or do I sell it when it gets to 9? Like, when it hits there, do I go, oh, this is like one of those crazy Berkshire's turned into a crazy growth stock at 9. I got to go ahead and get out of it,
Yeah.
or trim it down. So I think whether you do it by business fundamentals or whether you do it by valuations, you're always going to have an entry point and an exit point. I just think it's about finding a style that works for you and staying consistent with it.
Now, this is for me, Joe, more experience. I'm just questioning the role of experience in this market meltdown. For example, this is my first bear market, right? As an investor,
Right.
I mean,
Okay.
I was 2008. I could see things going down, but I couldn't care less because my money wasn't invested.
Right.
And then there was 2000. Now, I'm kind of reading a lot of people. Somehow, I think that a bit of foresight does develop with that experience. For example, I've gone through a beer market now, and some foresight would develop. For example, I would be very cautious of. I'm very clear on one thing, that when everybody is buying, there is something wrong. I'm very clear on that. Trust me, whether it will change or no. I mean, I used to take a walk in the park, and I would say, oh, my portfolio is 5% up, 6% up, damn, and give me a high. Now, that was a sign that something wrong is happening, or something increasing 10% daily, 8% daily. So I'm kind of developing into foresight, or leaning towards what Warren Buffett says, or that buy when everybody is fearful and sell when everybody is greedy.
Right.
And I felt when I'm not sure whether I will put it, but in some of the experienced investors, I saw that why that foresight wasn't there. Why so many experienced people were so gung ho about an upstart, or when there is so much of a problem for the disruptive companies, you can't believe them just in 1 year or 6 months. You have any view on that? Am I able to communicate my question to you?
Right. No, no, and that makes sense. And what I'm going to do is I'll kind of answer it in two parts. So
Yeah.
I think what the experienced investor does. So when you get an individual company like Upstart, because you brought up Upstart, um, Upstart was relying on loan volumes, and even though it was a kind of a picks and shovels for lenders in using its AI to pick out worthwhile customers to give loans to, it is dependent on consumer facing, how many loans, and do the banks want to underwrite it, and all those types of things. So um in that particular case, and I think this is where the experience helped me, when Upstart had its rough quarter, and I don't want this to sound like a victory lap because it's not, but when Upstart had its rough quarter in November, I sold everything, and I had about 30% in Upstart. And when it had that bad quarter in November, and it did not meet the number of loans, and it fell well short of what my expectations were, I didn't hesitate. I got out, and I sold. I want to say somewhere in the neighborhood, most of my shares around 270, and it had been as high as 400. So, I'm sitting there and I go, wow, that's a lot less than that's a lot less than what I had at one point. But I just got out at 270, and I had some shares in a taxable that I held because I didn't want to take the tax hit. And then I turned around and took the tax hit when it fell to about 140 about a month later. And now, Upstart's sitting at like $30. And I think from where the experience helped me with that was that once it no longer met my criteria, I didn't make excuses for it. I didn't find a reason to hold it. I was just like, this is not one of my best ideas, and I exited, because the experience told me that when companies no longer met my standards and I lowered my standards to try and keep those companies, I usually end up losing money. So I think that's how experience helps with individual companies. You're willing to just take the losses and move on.
Okay.
I think where experience helps you in markets like this is just that you've been there before and you've experienced it before. And it's not any easier in the moment. Like I'm not it's not like I'm sitting here going, wow, I'm really comfortable. I'm down 4 or 5% today. No, I'm feeling the same problems that you are. But I realize that I always have history on my time, and I always have time on my time, or history on my side, and I have time on my side. And when I went through 2000, and in 2000, I didn't have a lot of money in the market, relatively speaking, but it whipsawed, and I was like, whoa, this is, I survived. And in 2008, that was the first time that I had probably enough in there where when it was going down every day in 2008, 2009, I was like, whoa, like this is real money for me. And at the time, I'm looking at it and going, wow, this is super uncomfortable. And I wrote about this at one point. I can remember in November of 2009 or 2008, maybe it was 2009. I was at a relative's house for Thanksgiving, and I remember buying Buffalo Wild Wings and Marvel Entertainment, and like swallowing hard and forcing myself to click buy. They were beaten down so much, and I was putting in money every month. And I remember like forcing myself to buy those stocks, and those ended up being two of the best, purchases that I ever made, two of the most profitable purchases that I ever made. Not because I timed it right, because you can't time the market, but I got lucky and I bottom ticked it. And when you get that experience and you go through that and you realize there are a lot of companies that, we've talked about the May and June and all these bounces off there are a lot of companies and shares that people bought in May or June that even now they're holding on tight, and they're kind of white knuckling it a little bit, and they're going to wake up a year or 2 or 5 years from now and they're going to go, oh my God, those are some of the best shares that I've ever bought. So I think where the experience helps you with that is you realize that the stock market whipsaws up and it whipsaws down. And when it whipsaws down, you realize that it is going to come back if you have enough time. So I think that's where experience helps me, is with the psychology of it. I've been through this before, and it doesn't make it any easier to look at my account on a daily basis, but it does make it easier for me to not panic sell. It does make it easier to stay in the market with the capital that I have in there. And it makes it easier for me to stay with my process and stick with my process, because I know at the end of the day, whether it's a good market or a bad market or an up day or a down day, if you buy quality companies that do the things that are going to make them bigger in the future, you will be rewarded as a shareholder in the end. And that's the whole game. And if you find a way to do that, you'll be just fine. You'll be just fine.
Yeah, last question. Mental health. I see 40-50% decline. I think I subscribe to your newsletters. I follow you very closely.
Yeah.
How did you remain sane? The experience helps because you've seen it in the past, right?
Yeah.
But what did you
Yeah.
do? I mean,
Yeah, I think
any
that's
tips?
hard. It's hard. I mean, it really is, and it depends. I spend, some people, it's a balance, and I spend more time than most, working on my portfolio or looking at it, because I do actively manage it, and it is a concentrated portfolio, and the style takes some time, and from I exercise regularly. I go for a walk. I don't try to check prices every day. I do have a spreadsheet that updates when I put in the prices. I don't update it every single day. I might wait a week. And there's times where it's like, I might check and go, oh shoot, we're down 5%. I'm not updating it today. So you find your little ways, but it's really about understanding that everyone should have a whole lot of life going on outside of outside of their portfolios. And we're all investors at heart. For those that do manage our portfolio, we do have an investor role, but we also have a husband role and a father role and a person role and a professional role and all those types of things. And I think balancing those roles is one way to do that. But if you have not been through this before, and even if you have been through this before, to sit here and slough it off like it's no big deal at all is just being dishonest. But again, I've always taken solace in the fact I tend to be glass half full. I believe that optimists tend to fare better in the long run than pessimists. And if I pull a chart of any one of the industries and I just zoom out over any 10, 15, 20-year period, you're going to end up being better, at the end of that period than at the start of that period. And as you touched on earlier, and as I did, there probably is going to be a difference where I adjust kind of the growth part or the capital growth part versus the preservation part. I'm close enough to have to really start weighing that a little more heavily, but keeping things in context is probably the best way to try and approach the ups and downs, especially when you have a market like this.
Awesome. So I think on that note, Joe, thank you. Look, I mean, your honesty touches me. When I talk to investing bear, his humility touches me. I mean, the man made 1900%, and his Zen nature touches me. I think you probably aren't as Zen as investing bear is, or at least don't sound as Zen.
No, and I'm not. And
But
it's
you're bloody honest. You are
yeah.
so honest. I mean, I love that. Thank you so much. Joe.
No, you're very welcome. I consider him a really good friend. I think I've learned a lot from him.
Okay.
We've exchanged a lot of ideas, and
Mm.
he probably has as good a feel as anyone I know with kind of rolling with the punches a little bit. I'm probably more tactical in the way I
Yeah,
guess I
yeah, yeah.
try to
You're
try
very
to.
detail driven. He's I think he uses some intuition somewhere. Maybe I mean just
Yes,
like
yeah, he's got very good instincts, and
yeah, yeah,
he really trusts himself. And
yeah,
you know what? I trust myself too. And as I think as any investor goes along, everyone has a style that they can trust, even if it's just funding investing in an index fund every 2 weeks. Like that's you invest in an index fund every 2 weeks, and you start to doing that when you start working in your earlier mid-20s, you're gonna be just fine. So again, there's no one way to do it. I do believe there's a way to do it for everyone, and the journey is about finding the way that works for you. And discussions like this, I really appreciate you asking. I think discussions like this are worthwhile. I learn so much every time I do it, whether it be an interviewer like yourself or a fellow investor. But to be able to exchange and swap ideas, we kind of go through life stealing the good parts from each other. And I appreciate the questions you asked today, because it really helps to talk through them on my end as well.